It's December 2025, which means you have less than 30 days to get your books in order before year end. And if you're like most business owners, your books are a mess. You have no idea what your actual profit is, and you're about to pay thousands more in taxes than you need to, all because you waited until January to think about this. Here's the reality. Every single year, the same pattern repeats. Business owners ignore their books all year, then panic in January when their accountant asks for documentation they don't have. I'm going to walk you through the exact steps you need to take in less than 30 days to prepare for year end. The tax strategies you can still implement before December 31st, and how to avoid the costly mistakes that most business owners make. I'm John Conrad with Numeratus. We're a white glove accounting firm, and every single year we see the same pattern. I've worked with businesses that paid $10,000 to $50,000 more in taxes than necessary because they didn't prepare properly for year end. I've seen business owners lose legitimate deductions worth tens of thousands because they couldn't document their expenses, and I've watched businesses fail IRS audits because their books were an absolute disaster. Here's what most small business owners don't understand. Year-end tax planning isn't something you do in January when you file your taxes. It's something you do in November and December while you still have time to make strategic decisions. This leads us to point number 1, the bookkeeping disaster. Clean up your books now. Most business owners have no idea how much money messy books actually cost them. For example, an e-commerce business owner making about $500,000 in revenue might be busy fulfilling orders, managing inventory, and growing the business. Bookkeeping, that's something they'll deal with later. In January, their accountant asks for their books. They send over an absolute mess. Bank statements with no categorization, receipts in a digital shoebox, personal and business expenses mixed together, no record of inventory purchases, and missing documentation for major expenses. Their accountant spends 40 hours cleaning up the mess at $200 an hour. That's $8,000 just to get the books to a point where taxes can be filed. Worse, because documentation is missing, they lose $30,000 in legitimate deductions. Their tax bill is $15,000 higher than it should have been. Total costs of the messy books, $23,000. Do you have clean, up-to-date books right now? Or are you planning to deal with it in January? Here's what you need to do right now. Step number 1, reconcile all accounts now. Reconcile your bank accounts for every month of 2025. Reconcile credit card accounts. Reconcile any payment processors such as PayPal or Stripe. Make sure every transaction is categorized correctly. Step 2, separate personal and business expenses immediately. If you've been mixing personal and business expenses, stop immediately. Go through your transactions and properly categorize what business and what's personal. Step 3, gather missing documentation by December 15th. Collect receipts for major purchases. Get invoices for services. Document business meals and travel. Photograph or scan everything. Step number 4, review for errors by December 20th. Look for duplicate transactions. Check for miscategorized expenses. Verify income matches your actual deposits. Fix any obvious errors. If you do this now, you'll save thousands in accounting fees and avoid losing deductions. If you wait until January, you'll pay more and get less. Point number 2, the deduction hunt. Maximize what you can write off. The biggest opportunity in year-end planning is maximizing your deductions before December 31st. Here's what most business owners don't realize. Many tax deductions can only be taken if you actually spend the money before year end. For instance, equipment purchases, which is Section 179 deduction. If you buy equipment for your business before December 31st, you can deduct up to $1.2 million. And that's a 2024 limit similar for 2025, in the year of the purchase. For example, a construction business owner might need a new truck. They're planning to buy it in January of 2026. But buying it in December 2025 instead gives them a $50,000 deduction in 2025, saving them about $15,000 in taxes. If they wait until January, they won't get that deduction until they file 2026 taxes in 2027. Prepaid expenses. You can prepay certain business expenses and deduct them this year. Prepay 12 months of software subscriptions. Prepay insurance premiums. Prepay rent, if allowed by your lease, or prepay contractor services. A business owner can prepay $24,000 in software and services in December. This creates a $24,000 deduction, saving about $7,000 in taxes. Retirement contributions. Contributing to a SIP, IRA, or solo 401k before December 31st can create massive deductions. SIP IRAs up to 25% of compensation, or $69,000. Solo 401ks up to $69,000. A business owner making $200,000 in profit could contribute $50,000 to their solo 401k in December. This saves them about $15,000 in taxes while building their retirement. Bonus depreciation. Certain assets qualifying for 60% bonus depreciation in 2024, phasing down from previous years. This means you can deduct 60% of the cost immediately. Strategic spending before December 31st can save you thousands in taxes. You have to do it before year end. Once January 1st hits, these opportunities are gone for 2025. This brings us to point number 3, the income timing strategy. Defer or accelerate. You have some control over when you recognize income, and timing it correctly can save you thousands. Strategy number 1, defer income to next year. If you've had a high income year and you want to reduce your 2025 tax bill, consider deferring income to 2026. Delaying sending invoices until late December so they're not paid until January. Delaying completing projects until January. Defer bonuses or distributions until January. Now, of course, this really only takes place if you're on a cash basis. For example, a business owner with a $300,000 income year might have one project worth $50,000 that they could complete in December or January. Completing it in January instead could save them about $15,000 in taxes because their 2025 income is already pushing them into a higher tax bracket. By deferring the $50,000 to 2026, they save money due to the bracket management and deduction phase-outs. Strategy number 2, accelerate income to this year. Conversely, if you've had a low income year, you might want to accelerate income into 2025. Send invoices early so they are paid in December. Completing projects before year end. Take distributions or bonuses in December. A business owner with a $100,000 income year, lower than usual due to a slow period or the seasonality of things, might have $30,000 in receivables they could collect in December or January. Collecting in December could save them about $5,000 because their 2025 tax rate is lower than their expected 2026 rate. The key is understanding your tax situation and timing income accordingly. Point number 4, the entity structure review. Are you leaving money on the table? Most business owners never revisit their entity structure after they set it up. Many business owners set up an LLC or sole proprietorship when they started. They never revisited the decision as the business grew. Here's the problem. As your income increases, your optimal entity structure changes. A business owner operating as a sole proprietor making $150,000 in profit might be paying income tax on about $30,000, self-employment tax of about $21,000, about $51,000. Converting to an S-Corp changes everything. They pay themselves a $70,000 salary and take $80,000 as distributions. Their new taxes? Income tax of about $30,000, same as before. And self-employment tax on salary only of about $10,000. Total, about $40,000. That's a savings of $11,000 per year, every year. But here's the key. This election needs to be made by March 15th for it to apply to the current year, or within 75 days of forming the entity. If you're going to make this change for 2025, you need to do it sooner or later, not in January. Here's another example, single LLC to multiple entities. A business owner with one LLC doing $1 million in revenue might have significant liability exposure because all their business activities are in one entity. Restructuring into an operating LLC, low assets, high liability. A holding LLC owns equipment and intellectual property, low liability. And a management LLC provides services to the operating LLC, could protect their assets from liability and create additional tax planning opportunities and allow for more sophisticated wealth building. But this kind of restructuring takes time. If you're going to do it in 2025, you need to start now. Point number 5, the documentation disaster. Prepare for potential audits. Year-end preparation isn't just about taxes, it's about audit protection. The IRS is increasing audit rates, especially for small businesses. And the number one reason businesses fail audits is lack of documentation. Here's what you need to document before year-end. Business mileage. If you're deducting vehicle expenses, you need a mileage log showing date of each trip, starting and ending locations, business purpose, and miles driven. Without this, the IRS will disallow your entries of vehicle deductions. A business owner might deduct $15,000 in vehicle expenses, but have no mileage log in an audit. The IRS could disallow the entire deduction. They'd owe $4,500 in additional taxes plus penalties. Business meals. For meal deductions, you need a receipt showing amount, date, and location, documentation of who you met with, and the business purpose of the meal. A business owner might deduct $10,000 in meals, but can't document the business purpose. The IRS could disallow $8,000 of it. Home office. If you're taking a home office deduction, you need measurements of your office space, photos showing it's used exclusively for business, and documentation of your home expenses, mortgage, rent, utilities, etc. Contractor payments. If you pay contractors $600 or more, you need a W-9 form for each contractor, documentation of services provided, and proof of payment. Without W-9s, you can't issue 1099s, and you might lose the deduction. Gather this documentation now while you can still reconstruct it. Don't wait until you're in an audit and it's too late. Tip number 6, the tax protection. Know what you'll owe. Most business owners have no idea they'll owe in taxes until their accountant tells them in March. By then, it's too late to do anything about it. Here's what you need to know. Step number 1, project your 2025 income. Based on your books through October or November, project what your total 2025 income will be. Step number 2, calculate your deductions. Add up all your business expenses and deductions for the year. Step number 3, estimate your tax liability. Use tax software or work with an accountant to estimate what you'll owe in federal income tax, state income tax, and self-employment tax if applicable. Step number 4, compare to what you've paid. Have you been paying estimated quarterly taxes? Compare what you've paid to what you'll owe. Step number 5, make adjustments. If you're going to owe more than you've paid, you have 2 options. Pay estimated taxes before December 31st to avoid penalties, or implement tax strategies such as deductions and deferrals to reduce your liability. For example, a business owner might project in November that they'll owe $40,000 in taxes. They've only paid $20,000 in estimated taxes throughout the year. They can maximize equipment purchases for a $15,000 deduction, contribute to retirement for a $20,000 deduction, and prepay expenses for a $10,000 deduction. Their tax liability drops from $40,000 to $28,000. They pay the remaining $8,000 in December. Result, they avoid underpayment penalties and reduce their overall tax bill by $12,000. You have less than 30 days until December 31st, 2025. After that, your opportunities for 2025 tax planning are gone. This video showed you what needs to be done, the before and after. The bridge to actually implementing these strategies faster and easier is where Numeratus comes in. If you want to stay informed about year-end tax strategies, compliance requirements, and regulatory changes, join the Numeratus community at numeratus.org for $100 a month. We keep you on top of what you need to know. If you need a more hands-on approach, if you want year-end tax planning sessions, if you want to know exactly what you'll owe and how to minimize it, if you want professional guidance that ensures you're not leaving money on the table, book a consultation call at numeratus.us. We specialize in year-end tax planning for small businesses and entrepreneurs. If that sounds like something that's interesting to you, just book a call.